Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lithium Americas.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so the first thing that really jumps out with Lithium Americas is this kind of paradox.
A huge one. I mean, this is a company that's pre-revenue. It's all about building out one big project, Thacker Pass.
Right, so they're not actually making money yet.
Yeah.
And the Q3 2025 numbers, they really showed that.
They absolutely did. A negative earnings per share of, what, 83 cents?
Yeah, and the market was only expecting something like -5 cents. That is a massive miss.
It's a huge miss by any traditional metric. You'd think the stock would get hammered, but, and this is the key.
The stock actually went up.
Exactly. It climbed over 2% right after that announcement. It tells you everything about what investors are actually looking at here.
So they're just completely ignoring the current losses, the cash burn.
Completely. They are looking straight ahead to future production. What they needed was some proof that the company can, actually execute.
And they got that proof from their other operation, the one in Argentina.
That's the one, Rose. They hit 90% capacity utilization for 3 of the last 4 months. And October was a record production month for them.
So it proves the management team does what they're doing. They can run a mine.
It proves they can scale an asset, which is critical when you look at the long-term vision. They're targeting battery-grade lithium production for 2026, 2027 at Thacker Pass.
And that's before the big expansion with their partner Ganfeng. They're aiming to go from 60,000 tons to over 250,000.
Yeah, that's the long-term price. That's the kind of scale that gets the attention of, the entire global auto industry.
But all that scale only matters if they have a real advantage, a real moat to protect them.
And their biggest one is definitely political. It's all about their location.
Because they're in the U.S.?
Absolutely. They are, for all intents and purposes, the only major lithium project in the continental U.S. that's anywhere near production.
Which aligns perfectly with the push for U.S. energy independence.
Perfectly. And that alignment isn't just talk. It comes with serious financial backing. For one, the U.S. government actually bought a 5% equity stake in the company.
Wow. Okay, so they're not just a supporter, they're a shareholder. Their interests are directly aligned.
It's direct risk alignment. And then you have the really big money.
The Department of Energy loan. That thing is enormous.
Yeah.
Over $2 billion, isn't it?
$3 billion,
Yeah.
Guaranteed. This is what really lowers the risk of the whole project.
And it's non-dilutive capital, which is, that's huge for existing shareholders.
It's critical. It means they don't have to keep issuing new stock to fund the construction, and they've already drawn down the first $435 million, so things are moving.
So you have that massive government moat. What about the partnership with Ganfeng?
That's the second moat, maybe more on the technical side. Ganfeng is a top-tier global producer. They bring the expertise, they bring proven technology, and they share the capital costs. It just lowers the engineering risk.
Okay, so with all this backing, the project itself has to have some pretty impressive numbers to justify it.
The economics for Thacker Pass they're pretty stunning, actually.
Let's start with the NPV, the net present value.
It's a massive $8.2 billion after tax. For a company still in the development stage, that's an incredible figure.
And what about the return on that, the IRR?
33%. Now, you have to remember, that's based on a long-term lithium price assumption of $18,000 a ton.
Which might sound a bit optimistic to some people, given where prices have been recently.
It might. But here's the really important part. Even if you run a much more conservative scenario, let's say with lithium down at $12,000 a ton.
Which is much closer to recent lows.
Exactly. Even then, the IRR is still over 20%. That shows you there's a huge margin of safety and profit potential built in once they finally start producing.
And they have the cash on hand to actually get there.
Their balance sheet is surprisingly strong for a company that's just building. They had about $385 million in cash at the end of Q3.
And liquidity.
This is the part that's just wild. Their quick and current ratios are both at 3.8. Usually anything over 1 is considered healthy.
So 3.8 is exceptional.
It is. It signals that everyone is highly confident they can cover their short-term costs, probably because that DOE loan is seen as guaranteed future capital.
So they're in a very safe position to just keep building.
Very safe. They even added another $130 million debt facility. They have the runway.
Okay, so the fundamentals look solid. The backing is there. How has the stock actually performed?
Well, it closed recently around 576, and it has been volatile, which you'd absolutely expect from a resource stock like this.
But volatile to the upside, it seems. It was up 50% year-to-date in 2025.
Yeah, and a surging 68% over the past 6 months. It really, really rewards positive news.
And I'm guessing that news is almost always tied to the price of lithium?
It has a very high beta to the commodity. We saw it perfectly in November. Lithium prices jumped about 18.5%, and the stock surged almost 19%. It's a direct link.
So if you own this, you are making a directional bet on a lithium recovery.
You really are. And that government stake we mentioned, that's the biggest institutional thumbs up you can possibly get. It attracts a whole different type of investor.
You mean like ESG-focused funds and infrastructure funds?
Exactly. They see the green energy angle, the domestic supply chain security, and they're willing to be patient.
But the sentiment isn't all positive, is it? I saw something about Jim Cramer weighing in.
Right. That's the major bearish outlier. In December, he gave it a no-go call, told people to focus on AI instead.
And why does that matter?
Well, it just introduces some near-term noise and volatility, especially for the retail crowd that might have shorter time horizons. It shows you that patience is absolutely mandatory here.
So let's get into the risks. Because this is still a massive construction project, not a sure thing.
No, the number one risk is always pre-revenue execution risk. It's simple: construction delays, cost overruns, any kind of permitting setback.
Anything that pushes that 2027 production start date further out.
Exactly. That's where the ongoing cash burn really becomes a problem. A major delay could even affect their ability to draw down more of that DOE loan money.
And the second big risk has to be the commodity cycle itself.
Commodity risk for sure. That 33% IRR looks fantastic at $18,000 a ton. But if lithium prices were to collapse and stay below that $12,000 floor for years, the whole picture changes.
But their partner, Ganfeng, is pretty bullish on prices, right?
Yep. Very bullish. They're forecasting 30 to 40% global demand growth in 2026. So that's the powerful counterargument. They believe the current weakness is cyclical, not structural.
So looking ahead, what should investors be watching for? What are the key catalysts in the next quarter?
I'd say there are three main things. First, the Q4 2025 earnings release. You have to look past the EPS number again.
Right. It's all about the guidance.
All about the guidance for the Thacker Pass timeline. If they confirm they're on track for 2027, that's a huge positive.
Okay, what's number two?
Look for news on additional DOE loan tranches. Those drawdowns are tied to hitting specific construction milestones. So every time they take more money, it's concrete proof of progress.
And number three is just the lithium price itself.
Yep. Just watch the commodity price trajectory. As it recovers, the stock is very likely to follow, thanks to that high beta.
So when you pull it all together, what's the strategy here? This is clearly not a short-term trade.
No, absolutely not. You have to view this as a multi-year hold. Think 2026 through 2030. It's for a risk-tolerant, long-term growth investor.
Someone with the patience to ignore the negative quarterly earnings and the day-to-day noise.
Exactly. And given that the stock is trading closer to its 52-week low, the idea would be to accumulate on dips, maybe below that 550 support level.
Taking advantage of the long-term economics that have been largely de-risked by that government funding.
Right. And let me just leave you with one final thought to mull over.
Up for it.
So much of the focus for lithium is on EVs, right? Electric vehicles.
Of course.
But what if energy storage demand, I'm talking industrial batteries, utility scale grids, what if that really starts to overtake EV demand in the next decade, like some are predicting?
The total addressable market for domestic lithium would just explode.
It would explode. And that full $8.2 billion NPV could potentially be unlocked much, much faster than anyone is currently projecting. That's the real upside leverage in this story.
We hope this talk on Lithium Americas helps you navigate the market. If you found our talk useful, don't forget to subscribe and leave us a comment below. Thank you for joining us on Smart Wealth with Joshua.